Pramod Gubbi joins us, Managing Director and Head of Institutional Equities with Ambit. Pramod, this market surely has made a smart comeback. Crude at $70 plus, bond yields at 7.5%, rupee seems to be gliding, but markets are still moving higher.
Yeah, I mean, it is one of those things with a liquidity-driven market, right? So while foreign liquidity has been short of coming, domestic liquidity is held up pretty strongly, and that's clearly keeping the market stable. And also remember, I think we have some good news coming from the fundamental front in terms of growth picking up in the economy, and hopefully some of that will show up in the earnings season this quarter as well. While valuations aren't as attractive as maybe they had begun to be seen, say 2-3 weeks ago, but some sort of semblance of earnings growth returning is always positive for the market.
Pramod, just fascinating the way IT has been moving, and by IT it's not really the cluster, but names like TCS and some of the select mid-cap IT names. TCS has almost made it to that $100 billion market cap club. Infi, while it may not have impressed on the numbers, but you've got the CEO who's going to be meeting and holding an analyst meet today in Mumbai itself. What, according to you, are the prospects of IT, given the fact that already year to date this has been one of the leading sectors? Do you sense fundamentals can now catch up with the stock price moves?
Yeah, seems like, I think, at least going by TCS results, the sort of investment some of the Indian companies have made into the areas broadly called as digital, which is where the changing consumption behavior as far as their client base is concerned was panning out and was creating a challenge for the industry in general. Seems like those investments are coming to a head and beginning to bear fruit. There again, it's not across the board. Some companies are clearly doing better than the others. But that means that their competitiveness has increased at a time when the broad IT spend is looking up. The sort of tax cuts and the general pickup in the US economy, which is the largest market for the sector, clearly means positive tailwind from a demand perspective. And at the same time, the Indian companies have invested in their competitiveness. Add to it a potential tailwind in the possibility of the rupee depreciating as the year progresses. I think the prospects for the sector look pretty strong.
OMCs, what's the problem there?
Yeah, I mean, it's a bit of a surprise, really. It will be a surprise if it continues this way. Yes, the OMCs haven't managed to pass on the crude price increase through. It doesn't look like it's a market-driven pricing anymore, which was the reforms brought in by this government in terms of deregulating petrol and diesel prices. Now, of course, given where the stocks have gone, that means that the market is pretty much given up, or at least believing that these reforms have been backtracked, which would be a big blow if it turns out that way in terms of the government's ability to put sustainable reforms in place. So, which is why I believe I think that's unlikely to be the case, and this sort of fall should be seen as a great buying opportunity, because sooner or later we will see market pricing coming back, and OMC's profitability should pick up from here. So, yeah, I mean, I would be a buyer of OMCs at these levels.
So, okay, having said that about oil marketing companies, do you get a sense that the opportunity will squarely now be with the upstream names? Essentially, the likes of ONGC would benefit with rising oil prices if that becomes a reality?
Yeah, I mean, we really can't take a call on the oil prices sitting here. Of course, several factors working. There is clearly a pickup in global growth, which is adding to commodity prices rallying in general, but oil has other dynamics playing against it. Now, of course, it's pretty much a straightforward play in the sense if oil prices continue to rally, of course, the upstream companies come into play. But OMCs are in some ways ideally should be delinked from oil prices given the deregulation in place, which is why it makes a more predictable play given where valuations are. And perhaps on balance, I would still prefer OMCs over upstream companies.
Well, you know, oil marketing companies today are off to a decent start. Well, what is the showstopper today? It is Sasken Technologies, and this is one of those mid-cap stocks where nobody expected any kind of a constructive price action, and up it goes 11% on strong volumes. In fact, I will not be surprised if I look at IT company, mid-cap IT companies, then the P multiples now would be higher than that of Infosys, and that's largely because of growth rates are very, very different. Pramod, we are talking about a disruptive phenomenon which is at play in IT. And historically, I have seen that every time when there is a disruptive or a wave of technology which is changing, the large cap becomes better, the mid cap they suffer. But of late, mid cap IT stocks have done much better than large cap IT stocks. Why is that?
I think this time the disruption is at a different level, and also I think at this time when the disruption hit the sector, some of the large companies were really large, and to change tack, to invest in the way they sell their services and also deliver the services have been significantly different this time. So it's easier naturally for a smaller company to change tack as opposed to be a large company. But I think it's also a matter of more bottom up, where a select few Indian mid-cap companies have done great in terms of investing in these new technologies, facing the disruption head on, and managing to gain market share. I wouldn't rule out the large cap IT companies following suit, but clearly the mid-caps have found it easier or rather nimbler to move around the new digital technologies that's affecting the market.
Okay, let's just check in on some of the other pockets which are, you know, really moving the markets. And it continues to be the PSBs which are taking a knock today too. So if you look at Andhra Bank, that's down about 3%, the Scan Bank down 3%. OBC, Bank of India, these are all names down roughly about 2% or so. And ICICI Bank as well continues to bleed. That's down another 2.25%. Amidst reports that SEBI may be asking and seeking a forensic probe of ICICI books of accounts, and that may also date back to the time when Chanda Kochhar was actually appointed way back in 2006-2007. Pramod, suffice to say that it's best that one stays away from PSBs and some of these large private sector corporate banks as well, or do you think right now is the time to perhaps start nibbling in?
I guess PSBs is a relatively straightforward call to the extent that you know, nothing really has changed in terms of their governance. We're still waiting for the government to act on the several committees that have presented recommendations in terms of the way the PSB should be managed. So as long as that remains status quo, I guess we'll continue to stay away from it. The tougher call is the private sector corporate lenders, where you know it's not particularly PSU level governance. Hopefully that's better than that. There is value that you can see on the table. Of course, there is pain in the form of asset quality and stuff, but it's a balance between how much of that is factored in, and if you expect any sort of resolution to the governance structures there, which are distinct from the sort of governance challenges that the PSU banks faces. So there, I guess you should keep your eyes open to see if there's an opportunity. We can be more constructive there if certain things fall in place.
Well, the prospects of IT sector, they look good. Pramod, let's talk about valuations here. TCS is now trading at what, 21, 22 times 1 year forward. If one looks at the best case scenario, they will do double-digit growth. So isn't there a huge disparity between underlying valuations and what the earnings momentum is?
I think you would expect some sort of a leverage coming up in terms of a lot of the costs that went into the cost structure for these IT companies were in the form of investing into skills and technologies. Now is the time those sort of costs will bring revenue. So I would expect the sort of double-digit revenue growth to translate into slightly higher operating profit growth and earnings growth. And if the rupee sees some sort of a depreciation, you perhaps headed towards mid-teen sort of a growth, which is I guess given the sort of stability of the companies, the 2021 times is par for the course. I don't think there is scope for much of a re-rating from here on. Any sort of returns investors expect from the sector should be in line with the earnings growth, which is, like I said, mid-teens is perhaps a reasonable expectation.
Right. While you've given us your broad outlook on earnings, Pramod, what is the one sector you think that will really stand out post this earnings season? And the reason I ask you that is because we've seen real estate and fits and starts give out some selectively good numbers. And that's been the case even with some of the select specific investment-led construction companies. What to your mind will hold out?
No, I think commodities can be a good sector in terms of growth this time around, given the way the commodity prices have rallied. And clearly, in terms of anticipation of global growth sustaining, this sector has more legs to go. But in terms of the near-term earnings sector, commodities can be at the forefront in terms of driving growth. Perhaps some of the private sector financials as well, particularly the retail facing, we're seeing continued growth in retail assets, particularly personal loans and so on. And if you manage to have a decent liability franchise and growing fast your CASA liabilities, then you have the tailwind in the form of margin expansion as well. So perhaps these two sectors are worth watching out as far as earnings growth is concerned.
So Pramod, what is the overall call in the market, and would you say that maybe the worst is behind us in that February-March correction, or do you sense that there could be parameters or there could be conditions that could lead us to those sub 10,000 levels in the due course of this year as well?
Yeah, I wouldn't rule that out. I mean, given this sort of a plethora of uncertainties that could possibly hit the market, which will affect liquidity and so on, I wouldn't rule out the possibility that we can go back to those levels that we saw in February and March, and perhaps even lower if things get worse. Things like oil prices again, particularly worth watching out for. The U.S. Fed action and even the ECB QE action, which seem to be in a bit of a dilemma now. So generally global liquidity resulting from central bank action also worth watching out for, which can cause a bit of havoc in terms of the financial markets. So there's several such uncertainties, add to it geopolitical risks and so on, trade wars. So you can't rule out the possibility that we are back to the lows of March, or perhaps even lower than that.
Okay, great speaking with you. Thanks so much, Pramod, for taking the time out and chatting with us today.
You're welcome.